Hi, this is my digital director on taxes. There's one word that comes to mind when I think about taxes. It's the same word that most of you think about. It's the word yuck. Benjamin Franklin said that there is nothing as certain as death and taxes. And in this profession, we know about death. You can only imagine how, since we began having an income tax in this country, where the initial tax was 1% of income above $20,000, and that was 100 years ago, and got as high as 7% on income above $500,000. You can understand how we've screwed up taxes. My job today is to explain to you how to make your tax bill the lowest that it can be. I'm going to teach you that in 4 simple steps. Step number 1. What type of business enterprise are you? You have the choice of choosing what business enterprise you're going to operate out of. The simplest and worst is to be a sole proprietorship. Certainly, the taxes are paid at the individual level, but you have no protection in the event you commit an error in the operation of your business. The second is to assume that you have 2 silly, stupid people who are sole proprietors. Teaming together, that's called a partnership. That's double bad from being a sole proprietorship. Partnerships, bad. Sole proprietorships, bad. Now we have the option of corporations or limited liability companies. Corporations, there are 2 types. There's a C Corp or a standard corporation and an S Corp or a simple corporation. For most of you, the simple corporation is the best choice to make. The problem with a C corporation is it creates a tax level unto itself. And therefore, you'd have operating profits from your business be taxed at your C Corp level, and the tax rate is very low, far less than the individual tax rate. But you're going to wind up paying a tax on that income a second time when you take it out of that corporation, either as a dividend, as ordinary income, or as a long-term capital gain. So make life simple. Just be taxed once. That narrows it down to a subchapter S as a corporation. As a limited liability company, you also allow yourself to be taxed only once at the individual level. So typically, our clients, the operating business is taxed as a subchapter S, and the real estate is owned through a separate enterprise, which is a limited liability company, typically structured as a partnership style of limited liability company. Item 2. What method of taxation do you want to follow? There are 2 choices, cash or accrual. Let me explain the 2. Accrual is the way in which most businesses file their tax return. The business is assumed to recognize revenue the moment that it has signed a sales agreement. When a family comes in and makes an arrangement with you, at that moment in time, you have construed to receive the income, even if they're going to pay you in 30 days, 60 days, 90 days, or God forbid you take an insurance assignment. At the same token, under the accrual method, you have an expense to deduct the moment that you incur the right to pay that expense. Now, the alternative is the cash basis. Just as each and every one of us, when we file our personal tax return, we're taxed on the cash basis. That means that we get taxable receipt of money when we get cash money in hand. Not when somebody says the check's in the mail, but when you open the mailbox, receive the check, deposit it, that's when you're taxed on the receipt. By the same token, you get the deduction for the expense when you pay that. Now, here's the thing that's so unique about funeral service. Almost every funeral director I have met in my 35 years in this profession pays their bills in a timely fashion. So whether you're cash or accrual, your bills are paid and your deduction is taken within days of each other. But the receipt of income is totally different. This is why we have generally, as an industry, almost $350 million on the street at any given time in consumer receivables. So our recommendation? Real simple. Keep your books and records for internal management purposes under the accrual method. But when it comes time to paying your taxes, cash, cash, cash. The third option you have to decide upon is how are you going to own your capital assets? A capital asset is an asset that you invest in to help you in your trade or business. Typically in funeral service, this is going to be your buildings, your cars, even your desks, because they last more than 1 year. Now, most of you understand that if I own the real estate personally, I can now lease it back to my company. And in leasing it back to the company, I take the rent. The rent isn't subject to FICA, FUTA. So the rent is beneficial. And when you get ready to sell your business, it may even give you some options to be able to sell your business first and your real estate second. The objective, therefore, is to own as many of these assets as practical in a supplemental LLC and lease them back to the operating company. Almost every well-run funeral home does that with the real estate. Some even do it with separate cars. Some do it with computers. Some do it with phones. But choose to do it. It makes a difference, even if you're a subchapter S corporation. The fourth business decision you have to make is compensation. Don't get me wrong, you want as much as is reasonable, but there's a balancing act that takes place. Now, we used to have this balancing act kind of like holding a slinky, if you're old enough to remember that joyous toy. But we used to have this balancing act between how much do I take out as salary, how much do I take out as rent. The more I take out as rent, the less I have in Social Security. But today we have a three-legged slinky to have to juggle. We have salary, which has to be fair and reasonable. If you own your real estate through an LLC, we have rent, which also has to be fair and reasonable. And we have this third category. This third category is called business pass-through income. Business pass-through income is the profit at the end of the year. Now, if you're a C corporation, people would boost up salaries or boost up rents to try to have as little tax in the C corp. The easiest thing of all is, don't be a C corp. Now, in the event you're an S corp or an LLC, why should you take money out at the end of the year rather than take it out as a salaried bonus? Because in the 2018 Tax Reform Act, we had a new category of income. And this pass-through income, if done properly with the right business and the right equipment in that business and the right salaries in that business, as much as 20% of that pass-through income could be tax-free. That's because of something called the Qualified Business Income Deduction, or QBI. There is no obligation to pay more taxes than you need to. There is no obligation to do exactly what your buddy tells you to do who's been filing your tax returns for the last 27 years. Plan your taxes. Plan in advance. Don't wait until January 1st to figure out what you're going to do with the previous year's tax returns. Do this planning throughout the year. Trust me, it will save you money. That's my digital director on taxes. Thank you.